think I'd jump to this question, although I plan to ask this a little later in our conversation, Nick, which is really about, given the examples that you've just quoted of the scenarios and managing and preparing for risk containment, you're dealing really with CEOs, the business heads of various functions, and of course the operational and the risk department more generally. And the CFO, of course, yes. What has your experience really been, good or bad, in terms of familiarity of senior business leaders with the treasury function? Because it's technical, and most CEOs don't really come from that function. They usually come in from a business function and sometimes from a finance function, not necessarily well exposed to treasury. How have you found that journey in your career so far?
It's a very good point, and there are certain areas which are poorly understood. And almost every institution. Now, here's the crazy thing. The exception to this rule is JP Morgan, where Jamie Dimon knows more about one of the areas I'm about to mention than almost any other CEO that I've ever come across. And that is the area of behavioral profiling. Now, behavioral profiling, when you're in a bank, is critically important because we're talking about non-maturity deposits like CASA, which have a contractual maturity of overnight, but obviously a much longer behaviorally adjusted maturity. We're also talking about beta, which is how much of a change in market interest rates do you pass on to deposit customers when a market interest rate change happens. Price elasticity, how much change the price, how much volume changes, et cetera, et cetera. All of these areas, conditional prepayment rates on mortgages, time deposit redemption rates, all of these areas in banks that I provide training to are typically known by one or two people. The person who actually makes the calculation and maybe the person who reviews that. But these are critical assumptions that underpin the reports that go into ALCO. And they have such a transformational effect on balance sheet exposure management. They're so fundamental that the way in which you do it, and there's no one way that's universally right, the way in which you do it has a critical impact on the risks that you are actually managing, or the way in which you measure those risks. So this area, Francis, is very poorly understood, really poorly understood in ALCOs, in terms of its importance and in terms of actually how it works. And is that the best way? Now, for instance, what could you do? Well, you could, for instance, compare, this is the internal risk view of what it would look like using all of our AI, using all of our machine learning. This is how we see behavioral stability. And this is the way we're doing the core, non-core, if you like, for regulatory reporting purposes. And for how do they, let's have a look at them. How do they stack up one against the other? Are we being more conservative, less conservative? And the reason this is so important, Francis, it's not just a knowledge for the sake of it. It's because deposits are becoming more price sensitive and more flighty. And is that going to continue? Absolutely. There are more players, there are more wallets, more non-bank opportunities, banks competing harder. Everyone is competing for that CASA. Maybe that CASA is not going to be there all the time. So this is, over the next 5 years, this is an area that CEOs have to be all over it, in my view.
Actually, on CASA, Nick, have you begun to see that trend emerging in some markets where its percentage is dropping? People aren't keeping that kind of, those kind of balances in CASA and moving it to more profitable yet accessible alternatives?
I think this again is one of those changes, talking about the IMF, changes in the provision of financial services. One of the things that happened was we had a winner takes all change in the banking sector. And I'll get to the CASA on this. What I mean by that is the dominant local player became more dominant in every market. The foreign banks became less successful in those overseas markets, particularly in Asia. The rule that the playing field advantage that they had pre the global rules was eliminated, and the local banks really surged forward. And the two ways in which they went forward, one of them was in growing CASA, and they adopted this metric, CASA ratio, CASA over total deposits, really focused on it and drove it like crazy, and are still doing that. The other was mortgages, which they also pushed like crazy. So to your answer, the dominant players are not seeing the attrition. They're winner takes all. They're doing well. But the peripheral guys, not only are they seeing it's harder to retain, it's going to get even harder. So we're seeing this real difference in experience now. If you're the big dominant local players, where you've got the real captive market, the good collaborative relationships with partners, etc., great client experience, but you're seeing the growth still. But the other guys, the peripherals, they're going to really feel the pain. I think it's going to get very challenging for them. And the new players coming in, when you look at in Singapore, you've had the trust, you've had of course, the digital banks coming up, the GXS and others. They're all creating interesting propositions. So I think it's getting very tough if you're not one of those local dominant or new players. It's very tough, and it's going to get tougher.
And in your consulting role now, Nick, have you worked with non-banking players, fintechs and digital banks and the like, where the balance sheet composition is quite different? Perhaps CASA is certainly not as high and their profitable product lines might be slightly different. What could you share with us about?
Yeah, absolutely. I work with the digital banks in Singapore, Malaysia, Philippines, and the growth story is the same for digital banks. They basically bring the capital in, they invest it in government securities. The first thing they then grow is deposits, CASA. How do they grow it? They move the wallet money from their own company. Typically, there's a tech company as one of the stakeholders or investors in the digital bank. The wallet migrates to the bank. So they have rapid client growth, rapid balance growth. And then after a period of time, they start bringing in the loans. And then they phase in the time deposits. They all have the same growth pattern. So they have got a complete advantage versus the traditional banks because their sort of acquisition cost, because they're migrating from wallet, is totally different price to a bank that's trying to bring in, acquire new deposit clients.
Right, makes sense.
And so they're coming in, they're growing very, very rapidly. In some markets they got braked by the regulatory, the runway provided breakage before they could really go full out. But where they could go full out, for instance, the Philippines, the growth has been extraordinary. So all I'm saying is when you see that happening, you see the incumbent banks, the peripheral players are going to be in real problem. They're going to need some excellent treasury expertise to survive.
Thank you for that, Nick.